Kutzler YMX uses the Netrodyne two-way camera system in all of our power units. The Netrodyne cameras have more than once exonerated a driver who was perceived to be at fault, as well as saved our Kutzler YMX from paying damages related to an accident. We are already seeing, just in 1 year of Netrodyne, the impact of better safety scores and fewer damages and incidents in our insurance rates.
Welcome to Freightonomics, your weekly freight market and macroeconomic source of information. Zach Strickland, Tony Mulvey here, bringing you the latest industry supply chain news. We're going to have Dr. Zac Rogers today talk about the latest LMI readings. I think this one's going to be pretty interesting. A little bit of moderation in the market going on. We'll talk about that here in a minute. But first off, Tony, why don't we thank our sponsor?
Yeah, so thank you, Netrodyne. So remove the guesswork from driver management and fleet safety and start predicting your accident reduction cost savings. Netrodyne's AI-enabled video safety platform corrects unsafe driving habits, recognizing and reinforcing great driving. With the Green Zone score, your fleet of engaged drivers will protect your bottom line. Every 50 points earned is a 14% cut to your accident rate. So.
And we've got some stories that relate to said accident rates and their potential problem. The nuclear Warner verdict, of course, in the headlines. But, I kind of want to zip through things a little bit quickly so we get to Dr. Z.
Yeah, so Zach, we're going to move quickly in your market in two. So I'll count you in 3, 2, 1.
All right, tender rejection index up first. Wow, what a disappointing Labor Day from the transportation service provider perspective, a non-event for the freight market as rejection rates marginally increase, a little bit more responsive than they were this time last year, but not anything that anyone in the space is going to notice meaningfully. We barely got just above 4.5%, not even close to 5% target that I thought we would be well above for Labor Day, but we are back to what I would consider more of a seasonal trend. The trend of rejection rates are still trending higher year over year, but we have kind of pushed below that 2019 threshold. This is a slight concern from a transportation service perspective because that means that we are still in an extremely well-supplied market. It means you have to be very competitive to win business right now. Let's go to the next chart and look at tender rejection rates broken down by mode. You've got refrigerated there in blue, flatbed in yellow, and then dry van in white. The takeaway here, flatbed rejection rates. The flatbed market itself has moderated. We are now in a very recessive state for the flatbed market. Refrigerated side still maintaining an upward trend. Tender rejection rates on the rise. This is a seasonal thing that we expected to happen, and it's looking like it's maintaining to an extent. Less volatile than last year. And then dry van, moving down. So let's go to the next chart. Spot rates, NTI in white, flatbed in yellow, refrigerated in blue, similar to the rejection rate market, or the rejection rate data points, all showing similar movements and patterns. Flatbed on the downtrend, refrigerated on the uptrend, van pretty much flatlining right now. Let's go to the next chart and talk a little bit about Los Angeles. This is going to be the market to watch in the next few months. This is where all of that market deterioration and capacity is kind of deteriorated from. Rejection rates really falling down, even as you see tender volumes there. They actually increased right before the holiday. Tender rejection rates fell.
Interesting stuff.
So there's some dynamics in the market at play here. Like during the summer, if we pull that chart back up, I kind of want to expand on this. I probably should have just made this my entire 2-minute talk. But we saw rejection rates, which you're looking at in white, out of Los Angeles. So this is kind of one of our largest freight centers of origin freight in the United States. The port obviously a port complex has a lot to do with that. Tender rejection rates spiked during the summer. This was where most of the deterioration, the rejection rate increases arose during the summer months. This is why we thought the freight market, okay, maybe we are hitting a point where this is really starting to meaningfully turn. Well, tender volumes fell off, rejection rates fell off. I want to pull up another chart here, talk about Los Angeles versus long haul outbound tender volumes for Los Angeles and the rail volumes. you see the spike. The white line is the outbound tender volume index for long haul freight coming out of Los Angeles. Underneath it in pinkish purple is the loaded rail container volumes. Look at how responsive the rails have been. We've seen transition to the rail much more efficiently and effectively. This is a mechanism that was not present during COVID.
Yeah, the rails had their own issues, right? And I think that's some of it. And you heard often about the service component that the rails were failing miserably from a service perspective during COVID. They're not doing that now. And I think some of it has to do with there's not congestion other places. And so I think it allows the flow of containers to move better when you're not getting it from, Dallas, Chicago, or LA. I mean,
and there's no sense of urgency here.
That
right
too,
now.
right? We're looking at rail volumes. Like this should be the time they're growing. You think about it, like their peak, early November? Kind of mid
generally September.
Okay.
September, October is when the rail has its heyday. That's
because the time sensitive,
it follows the port peak season, the import peak season, and then it transitions into the truckload market, which has its peak season thereafter.
Yeah.
That's when the sense of urgency for a lot of the retailers is really driving a lot of freight market tightness.
And that's when you see rejection rates move higher, is when that time sensitive nature really kind of arises.
Yep.
And Labor Day, it's not the case. 4th of July, it's there because you got a combination of a few things. You've got summer stuff ending, so you want to clear that inventory. You need to start getting, schools feel like they're starting earlier and earlier. You need to get any back to school stuff on the shelves, call it early to mid-July, because heck, here they started school like the first week in August. So that stuff needs to be moving at that point.
Yep.
Labor Day, you don't really have anything. There's not a whole lot. And then, so I think that's part of the reason why you didn't really see this robust Labor Day or this major movement.
And during COVID, we had that sense of urgency all the time.
Yeah, because you couldn't go to a store and not have something in stock, right? Like you just needed it moved. It doesn't matter like what it was going to cost, and you don't have that at this moment. Like if it's not there today, well, odds are it's going to be there tomorrow, and it. So when you get into, call it, mid-November, right before kind of Black Friday retail season. Retailers clearly think that, the holiday season's going to be fairly strong. Spending trends kind of suggest that maybe that might be the case. So you may see more time sensitivity like show up in November, December than you had last year.
That's part of what we're going to talk to Dr. Z about here in a minute is what are they doing? Are the inventory actually increased this past month? So let's move into a couple of stories real quick before we pull on Dr. Rogers. LTL carriers see softer volume trends in August. Again, it sort of lines up. I think the LTLs you got to look at more from an industrial perspective.
Yeah.
Outside of one carrier. If you're looking at Saia, Todd Maton writes this, but Saia has transitioned publicly. They're talking about transitioning to a more retail-centric freight mix, which is going to be the lighter volumes, and they're the sole one that showed an increase in volume over the last year-over-year growth. Old Dominion and XPO both show pretty decent tonnage decreases, 6% for XPO, 10% plus in ODFL. But yields remain relatively strong for XPO, whereas they deteriorate a little bit potentially for ODFL. This is an intra-quarter update that Todd likes to cover. But XPO, ODFL, the two largest, biggest, most regarded LTL in terms of service, total package provider there. And some interesting notes. CEO Mario Herrick said that they manage their variable cost effectively in a soft demand environment, supporting our outlook for margin expansion. So they're managing their cost effectively. It's not a pricing increase. However, he goes on to say the industry's pricing backdrop remains constructive. Now, I don't know what that means, but our data suggests that it's not falling dramatically, but it certainly isn't getting tighter.
And I think some of the interesting things on the LTL side is, you're running up against when Yellow failed. You saw people react to that. And August, they went out in August. So that could be part of the reason. Like, you maybe don't see the growth because some of it moved, you heard rumblings, you moved that volume into to ODFL starting in July. And now the industrial sector has been,
well, the comps are going to be tougher from here on.
They get tougher, and then you have the industrial side of the economy that has struggled. I mean,
waiting on that rate cut.
They are waiting on a rate cut, but the question is, are they waiting on multiple rate cuts? Would be the interesting side to think.
And so the next story here, the appeal of the Werner nuclear verdict will be heard by Texas Supreme Court. Absolutely, shipper, carrier, broker, absolutely need to be following this story. This is $100 million nuclear verdict and in play here for Werner. Now, this is one of the big, and again, our sponsor definitely appreciates this story because this is a problem they're trying to resolve from the safety aspect. It is, read this story. They do a great job of covering like the basis of what happened here. One was killed. This is a tragedy, by the way. One child was killed, one left quadriplegic, and then one with significant injuries that were not sustained. But basically, the car they were in lost control. This was a winter storm event. There was black ice on the road. The driver of the car lost control, went into the truck's lane and hit the truck in their own lane. Across the median. Yeah. So the truck didn't lose control. But the ruling was found in favor of, against Werner, because they say that he should have been going slower in his own lane, even though the car came into his lane.
Yeah.
And then they went on to say that Werner didn't give this driver information about the road conditions, nor did he have access to devices that would inform him of the road conditions. And then it goes on to say he was a student driver with the second lowest possible score and with a high pressure JIT delivery. Now, none of these things make, and if this was just another car on the other side of the road, they don't go into driver records.
Yeah.
You're automatically, like, they swerved into your lane, you are at fault. But in the truck driving world, the truck is now liable.
Yeah, and you look at it, and I think the other part of this is, it's been almost 10 years since the accident. Like
2014, yeah.
Yeah, so, and we're 2024. So you're looking at, like, these things don't resolve quickly.
Yeah.
And I think if you had, shout out to our sponsor, but like things like this, it one might speed up this process, but also kind of may take some of the fault away.
But this is a challenge for all carriers.
Oh yeah,
like this is
the part you don't see in your daily or your monthly P&L, right? Like
driver records didn't have anything to do with the accident. It was black ice. The other car went into their lane.
Yeah,
and they're basically saying, essentially, this reads as, you're a truck driver. You're held to a much higher standard. And are now accountable for everybody on the road outside of yourself.
Yeah. Just think if this happened, if it was an autonomous truck and trying to do this.
That's why autonomous is a long way.
So hard. That's why it's so hard, right? Is there's so many uncertainties in the market.
Yeah. Well, let's move on to the LMI and Dr. Rogers. Let's bring him on to talk about this. This is so... Welcome,
hey guys.
Dr. Zac. I read this article yesterday that Todd wrote for us covering the LMI, and I was just like, oh, I need to get Dr. Z on so we can talk this through, because, I think last time we chatted was less than a month ago about July. We were talking about a market that was moving in a direction of tightening. But your latest readings are showing a little bit of a moderation in that tightness.
It is. We absolutely are. And these are the right lines to have up here, by the way, guys. And, to talk about this, first, I think I have to talk about football for a second. Okay. Isaiah and I, the producer of the show, were emailing back and forth yesterday. He went to Chattanooga, Tennessee. I obviously teach at Colorado State. And the combined score of our two games on Saturday, we played Texas and Tennessee respectively, was 121-3. Now, shouts out to him. They're the team that scored 3. I told him, I think the Rams and the Mocs are going to turn it around this fall, just like the freight market. And let me tell you guys, let me tell you what.
Here we go. Look at that segue.
I had 10 minutes to think about that one. All right. So anyway, basically what I didn't think about when we talked last time, and it was an oversight, I think by me, but it was tough to see. It's always tough to see the sort of shadow capacity that exists. I don't know that we always do a good job at capturing, okay, what's the extra capacity that's out there that maybe is sat on the sidelines. And that's really, in many ways, what happened with freight in the August report, because we still have transportation capacity, transportation prices read in at 61.6 in August, which is down a bit from July when they were at 63.8, but is still growth. But what I think happened is that 63.8, and we had positive readings for the 3 months before that, sent a signal to the sort of sidelined capacity. Hey, peak season is going to happen again. Things are going to move again. And so we saw capacity go from, it had been 50.7, and then all the way up to 56.7, which is growth. And that's the most growth we had seen out of capacity, I believe, since May. And to me, what this says is, one, that silent capacity is coming back. I mean, it's Labor Day is over, so we should be moving into the time where now things are moving more downstream. But also what it tells me, I actually think in some ways it's a good, not in some ways, I think it is a good sign, because it shows that there's some give, there's some slack in the market. I did another webinar yesterday, and somebody asked me, well, gosh, if we really do have a big season, a big holiday consumer spending season, like Tony mentioned earlier, will we be able to deal with it? And this, to me, the capacity number bumping back up to 57 tells me that yes, we do. Yeah, we will be able to move with this. We do have extra capacity that is coming online now, that was probably built up over the last couple of years and then had nothing to do for a lot of this year. That's now gonna get moving. And the reason I think we're going to get moving is because of what we saw in inventories. So our inventory level had been in contraction for the last 3 months. So May, June, and July. Oh, and it's even color coded. You guys are the best. It was contracting for the last 3 months. And you can see, if you look, going all the way back to last year, we didn't have a lot of positive movements in inventory levels. Well, we went back up to 55.7, which is expansion this month. And so that tells us that all of this activity we've seen at the ports, the Port of LA is like just getting crushed right now. I mean, they're up 20, 30, 40% year over year TEUs. Port of New York, New Jersey, busiest July of all time that just happened. I mean, we have stuff coming in. And now we're finally seeing the sort of that reflected in the inventory number going positive. Now, I do want to point out that inventory number largely still exists near the ports, at ports of entry, upstream. It's sitting at some of it's still sitting in manufacturers, suppose, but quite a bit of it sitting with wholesalers, distributors, LSPs. Our inventory levels, if you break out upstream and downstream, 59 upstream and 46 downstream. So we're still contracting downstream. Now, not as much as we were in July, but we're still contracting downstream. And what that tells us is we're sort of building inventories up. Inventories are building up, but right now they're not sitting on shelves. They're sitting where? Inland Empire, probably West Phoenix, Las Vegas, all of the sort of Western distribution hubs where we've built a lot of warehousing. Everything is kind of sitting there. And then it's going to start, I believe, pretty soon. Like you said, this is when we see a lot of intermodal activity, and intermodal, by the way, is up like 8% a year over year. So we are seeing a little bit of already. We're going to start seeing things move. And then once we get east, so, these trains are hitting Chicago, places like that, I would expect then to see the freight market, especially the downstream freight market, really pick up a bit. And this gets back maybe to what you said about LTL a minute ago being a little slow. One of the things I think is happening, guys, is with this 46 for inventories downstream, one of the things we also did say last time and maybe the time before is that JIT is really back with retailers. Retailers know now, because we do have slack in the supply chain, we don't have to act like we did in 21, 20, even a little bit in 23, where we get everything here really early. we didn't have normal seasonality, normal peak season really since 2019 probably. And that was because everyone was scared about not having enough capacity. But now that we know there is some stretch, a little bit of give in the market, we do have capacity. I think people are sort of keeping their powder dry and holding on to it. And we'll see those things like downstream transportation, downstream inventories, LTL, all of those things will pick up as we get closer to, probably October, November, because the one thing I don't think will change, we've said, okay, seasonality is back. The one thing I don't think will change is that we're not going to go back to the gear everything up towards Black Friday and Cyber Monday model. I think that downstream retailers and also consumers have found a lot of utility with instead of Black Friday, it's Black Fall. And we sort of have a longer holiday shopping season that it now seems to start in like mid-October. So Tony, school starts in August, Christmas starts in October. Welcome to 2024. But so I think that's probably, when we're talking about a fall comeback, just like the Rams and Isaiah, the Mocs, that's what we're going to see, at least according to our respondents and what their future predictions are as we go forward through the fall.
Yeah, I mean, I think Amazon is I'm going to blame Amazon for, moving Prime Day into October and really kicking it off, because all the retailers have to react to that. But I think some of the interesting
they made $14 billion on the one in July. I mean, why not have two?
Yeah,
you could do that twice. That's a great idea.
So looking further in the LMI, I like looking at the early versus late, especially with August, because you're moving into, right, kind of ramping up into Labor Day. You look at it, you see transportation prices pick up slightly in the back half, but I mean, it's not a meaningful increase where capacity kind of stayed stable. So, I mean, it to me, I mean, and I want to hear your thoughts. I mean, to me, it just shows Labor Day was kind of a nothing burger. And obviously we looked at rejections earlier and it kind of proved that too. But I mean, would you expect holidays to have larger impacts than what it did in this case?
Not Labor Day necessarily. I mean, that's kind of what do you do on Labor Day? You go to a lake. Yeah. I mean, I don't know. You're not. No one's like, oh, what'd you get me for Labor Day? I don't think we have that. Not like Halloween or back to school or Christmas, Hanukkah, stuff like that. I would say that you're right, Tony, that prices went up. We were at 59 in the first half of August, transportation prices, 63 in the second half. So we did see the rate of growth increase. We also saw the rate of growth of capacity stay pretty much the same, right around 57. And again, what I think that shows you is that despite all this capacity that was really coming in all through the month of August, prices did start to tick up. At the end, because really I think Labor Day Labor Day is an interesting holiday because it's not like a holiday where there's a ton of spending necessarily. There's a lot of driving, but there's not a lot of spending necessarily. So it's not surprising to see a little bump maybe right before, but really in many ways, it's the last day of summer, and so I think what we're seeing is a lot of fleets sort of building their capacity for the post Labor Day, and so I would expect that as we go forward through our September report, we will see that bump of capacity maybe level out a little bit. Not that we'll go negative, because even looking forward 12 months in the future, our respondents predicted capacity to be at 52, which actually would be a great number for it to be at. And prices will probably bump back up, especially on the sort of LTL downstream side, I would imagine, although LTL could come a little bit later. So no, I'm not surprised that Labor Day wasn't a huge injection of energy, because a lot of times I think, again, we're going back to regular seasonality, not like what we had in 2020 or 21 or 23, where it's like everything has to go as soon as possible. I think this is more of a, we've got the time, we have the capacity, let's follow JIT, let's not have crazy high costs, and let's move things in when they need to move in. If you look at our warehousing costs, today warehousing prices read in at 63. Compare that to a year ago, they were at 71. 2 years ago, they were at 75. 75, 71, those are huge spikes in warehousing costs. That's what happens when you don't follow the JIT models when everything's moving too fast. Now we're at what, 63? That's a great number for us to be at. And so retailers especially are being very mindful of their cost structure. So to me, no, it wasn't surprising that Labor Day wasn't a freight explosion, especially once I realized how much more capacity, because I thought maybe some of the capacity had already come back online, and some of it had, but there's apparently a lot more waiting in the wings that we didn't see. And so that's why I think August ended up the way it did.
Yeah, I mean, so you kind of hit on a thing that I was going to ask about, is the warehousing component of the LMI. Like, really, I love the context you put there, is that, yes, it's an expansion territory in terms of pricing. I know inventory costs have been a concern in the past, and that seems to be less of a thing now as the just-in-time returns. Do you think that the warehousing component, especially if we start to see, we have all these supply chain disruption events that are still kind of around. We've got the ILA upcoming at the end of the month that everybody's concerned about. Do you see the warehouses being at a point where they can kind of flex a little bit here and kind of absorb back into more of a just-in-case environment if necessary? Or do you even think that's going to be a thing?
I think they have the ability to. Because we built this apparatus for 2021 that's pretty strong, pretty robust. And if you look at warehousing capacity, it was negative. So we had contractions in warehousing capacity basically from summer of 20 all the way until January of 23. So even after the rest of the LMI components slowed down in early 2022, warehousing stayed hot all the way through 2023. Since that time, we've been sort of in the 50s and 60s in terms of warehousing capacity. This month, we were at 59.5. That tells you that we do have some flex space. Now, we don't always have the right space. And one of the places I think you can see that is when you look at upstream and downstream. It's funny. Traditionally, downstream has had a little more tightness because it tends to be in urban areas. Upstream, though, right now, our warehousing capacity was 56, and downstream's like a 67. So basically, what that says to me, is particularly for your question, is that downstream at 67, that means that retailers have space set aside for when things do get really busy. So if what we're talking about in Q4 is a consumer-driven economy, 67 for downstream warehousing tells me we have the space to accommodate it.
I mean, that's nice to hear. I mean, we've got a couple minutes here, but I mean, when we look at this kind of, if we're here talking with you in a month, looking at September's numbers, I mean, what would you be looking for? I mean, you start looking at some of these future projections, like I look at transportation prices being at 76.6. I mean, that's fairly high relative to where they've been. I mean, what takeaways do you think we need to be looking for in the September report?
Sure. And that 76.6, Tony, just to be clear, is a year from now. That's our 12-month future projection. So how much up will it be from now, right?
That's insane, by the way. That's COVID level.
No, well, but it reflects, I think, optimism. One, you guys already mentioned interest rates once today. There's a chance we're going to get 3 cuts in the next 4 months. That will really activate, I think, a lot on the upstream side, especially as we roll into spring and we start to see construction. If interest rates are low, we'll see construction happening. So that's what I think will happen there. And in terms of September, I would imagine that, like I said a minute ago, we'll see probably transportation prices up. The real key, though, for me, guys, is when that inventory level comes up downstream. That's the thing that really matters to me, is when we start to see, because right now, I mean, I literally pulled up the Port of LA today. For the week of September 15th, TEUs projected to come in is up 64% from year over year. I mean, we have all this inventory coming in, and it's got to go downstream eventually. And so that's what I'm looking for. And I think that's probably what the freight market is waiting for, is we know it's going to come. We have all this sort of potential energy up here that hasn't turned into kinetic energy. When I'd like to bring a little physics into it. When is that going to finally happen? And when that does happen, I think we'll start to see that sort of activate the freight market, especially the linkages between, say, wholesalers, retailers, and consumers.
Incoming.
Oh, did I take us right to the outro music?
Right to the outro. Hey, Who does Colorado State play this week?
UNC, we're gonna win.
All right. Good luck.